Okay, good evening to all of you. Welcome to our class today. And the last time that we met, we did introduce on financial forecasting through the use of the percentage of sales method. Okay, by the use of the percentage of sales method, and we did say, that conventionally, you can use a number of methods, when it comes to assessing or try to forecast the company financial needs. Okay, there are a number of ways or the number of methods that you can use when it comes to forecasting the company financial needs. Okay, and one of them, one of them is the use of the regression analysis. Okay, the use of the regression analysis. Okay. Which, as we did say, you did discuss this in the lower papers. Okay, you discuss this in cost accounting, all of that, in margin accounting. Okay, the other method you can use is the so-called the use of the cash flow forecast. Okay, which we have done this already together. Okay, how we do prepare the cash flow forecast. Okay, how we prepare the cash flow forecast. Okay. And the method that you have not done, is of which we did last time we met together, was the use of the percentage of sales method. The percentage of sales method. The percentage of sales method. Now, in this method, the percentage of sales method, we are simply trying to we make a comparison, assuming that that the company is at 100% operational, or it is operating and at 100% of its capacity. How to call 100% capacity utilization. That means, therefore, if the company would want to achieve an increase in sales, then they would have to consider, or the company will have to invest more, towards the asset, because since already what you have, the asset you have, are already 100% utilized. They are already 100% utilized. That means, therefore, if you're going to be investing more, if you're going to be, or in case you don't want to increase your sale, then by default, you must be investing more in your assets. You must be investing more in your assets. How will you say that? How we say that, when it comes to the use of the percentage of sales method, when it comes to the use of the percentage of sales method, there are a number of things that we do assume. There are a number of things that we do assume. I'll say that one of them is that we make an assumption that the company is operating at 100% capacity. Or there is 100% capacity utilization. Actually, I think we didn't discuss those assumptions. Maybe just can make a mention on the assumptions. So maybe you can make. So the assumptions. The assumption under the percentage of sales method. Assumptions. You see that one of the assumptions that you normally make, under the percentage of sales method is that the firm or the company is at 100% capacity utilization. What that means, therefore, is that if the company would want to expand, they would want to produce more, they would want to manufacture more units. That means, therefore, if you're going to be manufacturing more units, you're going to be buying, you're going to be attempting to increase your sales level. What does it mean? Therefore, you must, therefore, be willing to increase, the amount of assets you need to have, because already the assets you have, they are already fully utilized. In short, there's 100% capacity utilization. If you don't, therefore, if you don't want to increase the capacity of your assets, that means, therefore, buying more assets. That's what it simply would mean. There's 100% capacity utilization. The assumption you're going to assume is that if the company make profit, we're going to assume that there's profit. You don't want to increase your sales because you make profit out of those sales. Now, if that's going to happen, that is, the company is attempting to increase the sales, then they must make the profit. And the current net profit margin, okay, shall also be achieved even in future, okay? That even going forward, if the company has a net profit margin of 10%, even going forward, the same shall be achieved, okay? The same 10% will be achieved, okay? Not an increase, not a decrease, okay? The net profit margins, okay? The net profit margins margin, okay? The net profit margin of the firm, okay, shall be maintained the current net profit margin. So this should be the current net profit margin. Let me just put here. The current net profit margin of the company shall maintain even in future. Okay, should maintain even in future. Okay, shall be maintained even in future. Okay, the current net profit margin shall be maintained even in future. So what that simply means, therefore, is in case we do have 10% profit margin in the year 2020, okay, they're assuming that even in future the same shall happen. Okay, that even in future the same shall happen. Okay. Then another assumption you're going to make, okay, with the link I didn't mention last time, okay, or that you're going to assume, okay, so since more or less the capital need, well, we are simply trying to get, okay, we are simply trying to get capital, okay, that we can use, okay, in, we're trying to get capital that we can use as a company that is going to be essentially going to be used in supporting, okay, is going to be used in supporting the company, okay, short-term needs, okay, the company short-term needs. Then the company short-term needs, okay, the increase in the asset that the company wants in the next 1 year, the next 2 years, therefore they shall be financed not by long-term capital sources, okay. You're going to finance them not by the long-term capital sources, but through short-term finance sources, okay, unless otherwise told, okay. But conventionally, that's an assumption that we normally do make, okay, that the company, the need for capital, okay, or the company finance need shall be financed through short-term finances, okay. In some cases, the examiner sometimes can tell you to use long-term, but conventionally, we assume that since this is a short-term capital need, okay, because you want to increase the sales in the next 1 year, okay, since this is a short-term capital need, we shall be financing it using company short-term source of finance as opposed to the use of long-term capital sources, okay. The farm capital need, the farm capital needs, or asset increase actually, the farm's asset increase need, okay, farm's asset increase, okay, shall be financed through short-term finances, okay, as opposed to long-term capital needs, Okay, maybe just take a note here. Sometimes your examiner tells you to assume that we are financing using long-term. Okay. Okay. Sometimes the examiner. Okay, this is for the sake of exam. Sometimes the examiner can suggest that the asset increase will be financed by long-term capital sources. Sometimes, not always, long-term capital sources. Okay, that's another assumption that we do make. Okay, that the financing of the company assets, okay, is done through the company, is done through short-term finances as opposed to long-term finances. However, you have to be quite careful, okay, what the examiner is informing you, okay, what the examiner is informing you, okay. An assumption that generally do make is that the ratio, okay, the ratio of the assets versus the sales, okay, the way we did, for example, comparing what was the inventory investment versus the sales, okay, simply what is the percentage of sale of each of the account, okay, that ratio, okay. Let me just take you back to what we were discussing last time, okay. These were the percentage of sales. Yes, okay. Like for example, we had the case of inventory non-current assets was 60%, 25, 35, and 20%. So we also make an assumption that even going forward, okay, that even going forward, we shall be having these ratios, okay, the ratio of the investment, okay, or the asset versus the sales, okay, remain constant even in future, okay. If, for example, this is year 2018, assume this account for year 2019, that even in the year 2020, the same shall maintain. Okay, the same shall be maintained. Okay, that is another assumption we do make. Okay, it's not always going to apply. Okay, but there's an assumption that the method normally do make. Okay, that the percentage, okay, of sales for each account shall be maintained even in future. The percentage of sales for each account, for each of the balance sheet accounts, okay, shall be maintained. Okay, shall be maintained even in future, even into the foreseeable future. The foreseeable future. Okay, that's an assumption that we're making. Okay, that if inventory versus sale, okay, or rather the ratio of inventory and the sales figure for that year was 60%, then we assume that even going forward, the same value shall be maintained. The same value shall be maintained. Okay, the same value shall be maintained. Okay, that's another assumption that the method normally makes. Okay, maybe another assumption. Okay, that the method normally makes. Okay, is that long-term capital equity, and debt, long-term debt financing, long-term debt capital sources, debt capital long-term debt capital sources shall be maintained. Equity and long-term debt capital shall be maintained. Okay, so more or less like, okay, this assumption, okay, it's more or less like what you've just discussed here. Yes, here, this assumption, okay, that the financing that the company needs, okay, company needs is financed is short term, okay, that implies therefore the company equity as well as the long-term debt capital, okay, shall be maintained, or the company does not finance using long-term finances, okay, of course, based on the condition that you just mentioned, okay, that sometimes the examiner can actually tell you that the financing shall be done through long-term capital, but that's not the case. Okay, conventionally, okay, that's not the case conventionally. Okay. Another assumption, making the assumption before the financing of the company of the assets, the finance of the assets increase, the financing of the assets increase, The financing of the asset increase is first financed using the spontaneous finance sources. Okay, any extra capital need may be raised through external financing, finances or financing. But first of all, okay, we're going to raise the money from the spontaneous finance sources. Okay, first of all, before you go to the market to borrow money, okay, first check whether the company has enough capital. I think we mentioned that, but it is still an assumption. Okay, it does not mean that the company will always be like that. Okay, that's not always going to be the case. Okay, that's not always be the case. Okay, on the spontaneous finance sources. I think there's some more assumption, okay, but as time goes by, we shall be discussing them. Okay, there are more assumptions, but we shall be discussing them as time goes by. Okay, these are some of the assumptions that we do assume. Okay, now, okay, so I would want as we do a question, okay, from your examiner. Okay, a question from your examiner, okay, on determining, or rather, trying to determine external finance that is required. The external finance required by the company based on an increase or a prospective increase in the company's sales. Okay, so I'm going through your question bank, okay, trying to see whether you can find such a question, or for sure there are very many actually. So you can get some of those questions. Okay, if you check on the November 2016, okay, in a question here, November 2016. November 2016, question 3A. Question 3A. November 2016, question 3A. Okay, so go through it, then we shall attempt it together. Okay, go through it, then we shall attempt the question together. November 2016, question 3A. Take 2 minutes to go through the question. Okay, I suppose that you have gone through the question, okay, and you have been able to more or less, okay, understand what the examiner is trying to ask of you. Wow. Okay. Now here required, Roman 1, the amount of external finance, okay, required. In this case, as I mentioned, the examiner is telling you actually that external finance, any external finance shall be effected through long-term debt capital, okay? So in this case, therefore, we go as per the examiner is telling us. Then 2, prepare a forecast SFP, and 3, you comment on the weakness of the method. The assumption of the method and the weakness of the method. Okay? If this assumption do not apply in reality, then those assumptions become therefore the limitation of the method. Okay, so number 3 is simply critiquing the assumptions. Okay, so simply taking the assumption, then you critique it. Okay, why can't this assumption apply in reality? Okay, so simply critiquing those limitations. So number one, the amount of external finance required. Okay, so don't forget, in this case, you're using the percentage of sale method, even though we have not been told to use it, but you know, okay, rather that the game using, therefore the percentage of sales method. Okay. Okay. So you can begin. The first step, of course, is for you to identify the accounts or the balance sheet accounts that are going to vary in line with the sale. Okay, in this case, there's PPE. We have here we have the property, plant and machinery. We have furniture. We have motor vehicle. We have inventory. We have account receivable. We have cash. We have payables, and we have the accrued expenses. Okay. So those are the accounts that are going to vary in line with the increase in sales, okay? In line with the increase in sales. But therefore, that's the first step, okay? Which actually you don't need to write it down, okay? You just, okay, know, okay, on top of your heart, okay? What are the accounts that are going to increase in line with the increase in sales, okay?